I've been staring at this chart for 3 days straight. Something is wrong. Something that nobody is talking about. Something that changes everything we thought we knew about Friday's crash. At first, I thought I was seeing things. I pulled up the data again. I checked different sources. I compared multiple charts from multiple providers, but the numbers just did not change. And the more I looked, the more disturbed I became. Let me show you exactly what I found. This right here is silver. Friday's crash, 39% down from its peak. This was the biggest single-day drop in modern history. You probably know this already. It's what everyone is talking about. It's in every headline, on every news channel. Every analyst, every YouTube video is shouting the same thing. Silver crashed. Retail investors got destroyed. Trillions of dollars were wiped out. But this, my friends, is what nobody is showing you. This is the piece of the puzzle that has kept me up for 3 nights straight. This is CL, the Silver Miners ETF. These are the companies that actually dig the physical silver out of the ground. We're talking about real mines, real production, real businesses with real employees, and real heavy equipment. These are the foundations of the entire silver industry. Now, here is where it gets incredibly strange. Miners always, and I mean always, move more than the underlying metal itself. It's a fundamental principle. If silver goes up 10%, the miners, due to their operational leverage, typically go up 20%. If silver goes down 10%, miners will usually drop 20%, sometimes even more. This relationship, this leverage, has held true for decades. It's one of the most reliable, almost textbook patterns in the entire commodities market. It's something you can practically set your watch to. So let's look at Friday again. Silver crashed an unprecedented 39% from its peak, the most violent, brutal drop in living memory. If that historical pattern held true, the miners, the SIL ETF, should have crashed by at least 60%, maybe 70%, or even a catastrophic 80%. It should have been an absolute bloodbath for these companies, but they didn't. The miners, they only dropped 22%. I stared at this chart for hours, trying to make sense of it. How is this even possible? The entire silver market is supposedly collapsing. Trillions of dollars are being wiped off the board. Retail investors are getting margin called and completely destroyed. And yet, the mining companies, the very businesses whose entire existence and profitability depend on the price of silver, they barely even moved. It just made no sense at all. It was like watching a hurricane tear through a city, but one neighborhood remains untouched, basking in the sun. It defies logic. And then, in the early hours of the morning, it finally hit me. Smart money didn't sell. Just let that sink in for a second. The institutions, the hedge funds, the massive pension funds, the family offices, the people who manage billions, even trillions of dollars. The people who have entire teams of PhD analysts and access to information and data feeds that you and I will never, ever see. They did not panic while silver was crashing at 39%, while retail traders were getting those dreaded margin call notifications, while brokerage accounts and portfolios were being forcefully liquidated all across the world. The big players, the so-called smart money, looked at their mining stocks and calmly said, "No, we're not selling." They held their ground. Why? Why would they hold on to mining stocks when the price of silver is in an absolute free fall? Why wouldn't they just dump everything and run for the exits like everyone else? There's only one logical explanation, one conclusion that fits all the facts. It's because they knew something that we didn't. They knew the crash wasn't real. That thought, that single realization, kept me up all night. If this crash was manufactured, if it was a fake out, if smart money knew it was coming and positioned themselves perfectly while retail investors got absolutely slaughtered, then there has to be evidence. I looked at the options market. Retail traders had piled into call options, betting on silver going higher. When the crash hit, those options became worthless overnight. Billions in retail premiums gone. But who was on the other side of those trades? Who sold them those calls? The institutions. They collected all those premiums, pocketing a fortune as retail's dreams turned to dust. Then I looked at the futures market. Leading up to the crash, we saw a massive buildup of short positions from the commercial banks, the big players. They were betting heavily that the price would go down. And at the same time, the non-commercials, which includes smaller speculators and retail traders, were overwhelmingly long. They were betting on the price going up. It was a perfect storm, a trap set with incredible precision. The big banks knew exactly when to spring it. But the miners are the key. Holding the mining stocks was their tell. It was their giveaway. You don't hold on to shares of a gold mining company if you think gold is about to become worthless. You don't hold shares of an oil company if you think oil is going to zero. And you certainly don't hold shares of silver miners if you believe silver is genuinely collapsing. Unless you know the collapse is temporary. Unless you know it's a manipulation designed to shake out the weak hands, to liquidate the leveraged retail traders, and to allow you to accumulate even more assets at artificially low prices. This wasn't a crash, it was a heist. A massive, coordinated transfer of wealth from Main Street to Wall Street. They created the panic, they profited from the panic, and then they stood by, ready to buy back the assets from the very people they just terrified into selling. They used the financial media to amplify the fear, with headlines screaming about the end of the silver bull market. They triggered the margin calls that forced automated selling, creating a downward spiral. And while all of this was happening, they were quietly holding onto their core positions in the miners, knowing that once the dust settled, the fundamental reasons for owning silver haven't changed. The inflation, the debt, the currency debasement, all of that is still here. In fact, it's getting worse. They played the game perfectly. They shook the tree so hard that all the retail apples fell off, and now they're coming back to scoop them all up for pennies on the dollar. The fact that the miners, the SIL ETF, only dropped 22% while silver dropped 39% is not a fluke. It's not a market anomaly. It is the smoking gun. It is the proof that the big institutions, the smart money, were not scared. They were not selling. They knew this was a manufactured event. It means you have to learn to see the market, not for what they tell you it is, but for what it actually is. It's a battlefield. And you need to pay attention to what the generals are doing, not what the news anchors are shouting. Don't watch the price of silver itself. Watch what the miners are doing. They are the canary in the coal mine, or in this case, the canary in the silver mine. Their resilience in the face of this crash tells you everything you need to know. This isn't financial advice, but it's a plea to think critically. Don't let them scare you out of your positions. Don't let their manufactured panic dictate your financial future. The game is rigged, but by understanding their playbook, you can learn to play it too. Look at the data, follow the smart money, and don't believe the hype. The real story isn't the crash itself. The real story is who didn't sell. Flipped based on a few public signals. It all started early in the week with comments that hinted at a weaker dollar. Naturally, traders everywhere thought this meant precious metals were about to take off. The idea spread like wildfire, and everyone, from huge institutions to individual investors, piled into the same trades. Money just flooded into precious metals. By Thursday night, the excitement was at a fever pitch. Silver prices hit record highs, and the optimism was off the charts. You heard analysts everywhere talking about how this was just the beginning, predicting long-term gains. But then, everything changed in an instant. Early Friday morning, before the markets even officially opened, a surprise announcement hit the wire. Kevin Warsh, known for his strong dollar stance, was nominated for a key position. This single piece of news completely reversed the week's expectations. Suddenly, all those traders who had bet on a weaker dollar were caught on the wrong side of the market. A massive scramble to get out of those silver positions began. In a matter of hours, prices plummeted as everyone tried to sell at once. It was a classic bull trap. What was really strange, though, was that while the futures market was in chaos, the prices of many mining stocks barely budged. That discrepancy just raised more questions and made a lot of people wonder what was really going on. Today, we're going to take this a step further. We'll explore some of the historical practices that have influenced the precious metals markets, and it's a story you need to hear. One of the key concepts we need to understand is called spoofing. Now, spoofing is an illegal form of market manipulation. It's when a trader places huge orders to buy or sell something, but they have absolutely no intention of actually going through with the trade. These fake orders create a false sense of supply or demand, tricking other traders into making decisions based on bad information. Once the market moves in the direction the spoofer wants, they quickly cancel their fake orders and cash in on the price change they created. This isn't just some conspiracy theory. Spoofing is a serious crime, and it's explicitly banned under U.S. law. In fact, between 2008 and 2020, several of the world's biggest financial institutions were found guilty of manipulating precious metals markets. We're not talking about allegations here. These were actual convictions with massive financial penalties. One of the most famous examples is the case against J.P. Morgan Chase. In September 2020, the Commodity Futures Trading Commission, or CFTC, released an order detailing years of manipulative and deceptive conduct by the bank. This included widespread spoofing in the gold and silver markets. At the time, it was the largest fine the CFTC had ever handed out. But it didn't stop with just a fine. Several of them were convicted in federal court for their roles in the scheme. The charges were serious, even including racketeering, which is a charge you usually hear in connection with organized crime syndicates. That alone tells you how systematic and coordinated the regulators and courts found this misconduct to be. These weren't just a few rogue traders. It was a deeply embedded practice. It gives us the context for why so many experienced market watchers get skeptical when they see sudden, extreme price swings, especially in precious metals. Of course, many factors can influence market prices, from economic data to geopolitical events. But these past enforcement actions are undeniable proof that deliberate manipulation has been a very real and powerful force at certain times. It's a reminder that the game is sometimes rigged, and the official story isn't always the whole story. When you see a market move that just doesn't make sense, it's worth asking if there might be something else at play, something happening in that hidden economy. The story of spoofing in the precious metals market isn't just a piece of financial history, it's a warning. It shows how powerful players can bend the rules and distort prices for their own gain, leaving everyday investors to deal with the fallout. This isn't about being cynical, it's about being realistic and informed. The more we understand these hidden dynamics, the better equipped we are to navigate the complexities of the financial world. So, the next time you see a headline about a sudden crash or a surprising spike in gold or silver, remember these stories. Remember the convictions. These aren't just stories. These are real people, real names, and real prison sentences for running a criminal enterprise from inside one of the biggest banks in the world. And JP Morgan wasn't acting alone. HSBC was fined $76 million after 9 years of cheating. Deutsche Bank was caught with a $75 million penalty. They'd been rigging markets since 1999, a full 15 years before anyone even noticed. Morgan Stanley was caught too. 5 major banks, all convicted, all fined. And what happened next? They just paid the fines and went right back to work. Business as usual. Now, I know what some of you might be thinking. Is this some kind of conspiracy theory? Absolutely not. Court documents, government reports, and official filings that anyone can look up. For over 2 decades, these powerful institutions were manipulating the prices of precious metals, and it seems regulators were just looking the other way. The only reason they ever got caught was because brave whistleblowers came forward. And even then, the penalties were a joke. The fines were pocket change compared to the mountains of profit they were making from these schemes. Let's put it in perspective. $920 million sounds like a massive number, right? But for a giant like JP Morgan, which made over $40 billion in profit in 2022 alone, that fine was less than a rounding error. It's a tiny fraction of their annual earnings. It's the equivalent of you or me paying a $5 parking ticket. It's annoying, but it's not going to change our behavior. It's just a cost of doing business. So here's the question that really kept me up at night. The one that should concern all of us. Do you honestly believe they stopped? The bank itself admits to running a criminal enterprise for 8 straight years. And then what? They suddenly have a change of heart and decide to play fair? It's the same people, sitting at the same desks, using the same strategies, driven by the same incentives for massive bonuses. The fine wasn't a punishment, it was a line item in their budget, a speeding ticket they were happy to pay to keep the game going. This is where it gets really interesting. I decided to dig deeper, to look at the raw data myself. Let me show you what I found when I looked at the data from Friday, January 30th, 2026, the exact day of the infamous crash. This document right here is the COMEX delivery report. It's published every single day by the CME Group, the world's largest financial derivatives exchange. This report shows exactly who is trading, who is closing their positions, and who is taking physical delivery of the commodity. Most people have never seen this document. Most people don't even know it exists, but it tells you everything you need to know if you know where to look. Now, focus on this column. It says stopped. In the world of futures trading, stopped means contracts that were closed out, positions that were exited. So if you were holding a short position, meaning you bet the price would go down, and you stopped a contract, you closed your short and locked in your profit. It's how you cash out. Now, look at line 6061. It reads, JP Morgan Securities. And next to it, stopped. 147 contracts. That's 147 contracts closed on the exact day of the crash. Let me break down exactly what this means, because it's crucial. When you are short on silver, you make money when the price goes down. The lower it goes, the more you profit. JP Morgan held these short positions. On that fateful Friday, the price of silver plummeted by 39%. And at the absolute bottom of that crash, JP Morgan closed 147 of their short contracts. They didn't just exit their position. They exited at the lowest possible price of the day, securing the maximum possible profit. Their timing was, for lack of a better word, perfect. Let's rewind for a moment to get the full picture. On Thursday night, silver was trading at an all-time high of $121 an ounce. Every analyst was bullish, every headline was screaming buy. The market sentiment was overwhelmingly positive. Just 12 hours later, silver had crashed to $75. $46 of value erased in a single trading session. And somehow, amidst that chaos, JP Morgan knew the precise moment to cash out. They didn't close their positions on Thursday when the price was at its peak. They waited. They closed at the exact bottom tick of the day. This is the very same bank that paid a $920 million fine for rigging the silver market. The same bank whose traders went to prison for market manipulation. The same bank that admitted, in court, to placing hundreds of thousands of fraudulent spoof orders to move prices in their favor. And that very same bank just happened to time the exact bottom of the biggest and most sudden crash in the history of the silver market. Is it just a coincidence? Or is it something else? Think about the odds. For a trader to perfectly time the top or bottom of a market once is considered legendary luck. To do it consistently is almost impossible. A bank with a documented history of manipulation, a history they have admitted to, pulling off a trade that seems too perfect to be true. They didn't just get lucky. They executed with a precision that suggests they knew something nobody else did. They knew where the market was going before it got there. How is that possible without having some control over the market itself? This isn't just about one trade on one day. It's about a systemic issue. The financial system is supposed to be built on a level playing field. But what we see here is evidence that the game is rigged in favor of the biggest players. They have the capital, the technology, and apparently the willingness to bend or break the rules to ensure they always win. The fines they pay are simply the cost of admission to a game where they control the outcome. While retail investors and smaller players are wiped out by these sudden, violent market swings, the institutions behind the curtain are reaping massive profits. And this brings us to the most important point. What can we, as individuals, do about it? The first step is awareness. Understanding how these markets truly operate is your best defense. Don't just follow the headlines or listen to the mainstream analysts who told everyone to buy silver at its peak. You need to look at the underlying data, understand the incentives of the major players, and recognize that the system isn't always fair. This knowledge is what empowers you to make smarter decisions with your own money and to protect yourself from these manufactured market events. The story doesn't end here. The data tells a story that continues to unfold every single day. What happened on that Friday was a wake-up call. It was a clear signal that despite the fines and the prison sentences, the core problems in our financial markets persist. The incentive to manipulate is still there, because the rewards far outweigh the risks. As long as the penalties are just a slap on the wrist, a small fraction of the illicit profits, this behavior will continue. These institutions have shown us who they are. They've admitted to being a criminal enterprise. The question is, are we going to believe them? Are we going to keep playing a game where the odds are stacked so heavily against us? Or are we going to demand real change and accountability? The choice is ours. Thanks for watching. Stay informed and stay safe out there. Remember the silver crash of 1980? Silver soared, threatening the system. Then the exchange changed the rules mid-game. No warning, no explanation. Just new rules that instantly destroyed anyone holding silver. The price plummeted from $50 to just $10. An 80% wipeout. Thousands of investors gone. Fast forward to 2011. Silver rockets from $8 to $50. Social media is buzzing. Retail traders are piling in, and the silver squeeze movement is born. What happens next? The CME raises margin requirements 5 times in just 9 days, a massive 84% increase. The result, silver crashes from 50 down to 26, a 50% destruction. It took 13 long years for the price to recover. Now, let's imagine it's 2026. Silver has just completed the biggest rally in history, running from $26 all the way to $121. Social media is on fire. What do you think happens? The CME raises margins before the crash, during the crash, and even after the crash. China raises its margins at the exact same time. The Fed chairman makes an announcement timed for maximum damage. And guess what? The big banks close their short positions at the absolute bottom. Silver crashes 39% in a single day. The fastest, most brutal takedown of the three. 1980, 2011, and a hypothetical 2026. Same pattern, same tools, same playbook, same destruction. Every single time silver threatens to break free, every time regular people start making money in precious metals, every time the price exposes the weakness of paper money, the same script plays out. Once is an accident. Twice is a coincidence. 3 times is policy. And that is exactly why smart money held onto their mining stocks. They've seen this movie before. They know how it ends. They know the price always recovers after the manipulation. The miners are telling you something. They're waiting. Because this crash wasn't real. It was paper manipulation, manufactured chaos, a coordinated attack designed to shake out the weak hands and let the criminals exit their losing bets at the bottom. The physical market knows the truth. On that Friday, when the paper market screamed that silver was $75, dealers around the world were selling physical silver for $120 to $150. That's a 40 to 100% premium over the fake paper price. If silver was really worth $75, why were people lining up to pay double? Why were coin shops sold out across the country? But here's where it gets even crazier. I want to show you something that happened this weekend. Something that tells you everything you need to know about the state of the physical silver market. Golden State Mint, one of the largest private mints in America, shut down silver sales for the entire weekend. Their official statement, and I quote, was that they were not able to secure silver. End quote. Let me say that again. One of the biggest mints in the country could not get its hands on physical silver. They had to stop selling because there was literally no metal to sell. The last time this happened was during the peak of the COVID panic in March 2020, when the entire world felt like it was falling apart, when the financial system was on the brink of collapse. That is the only other time in recent memory a major mint had to shut down sales because they couldn't source metal. And it just happened again, right after Friday's crash. Think about what this means. The paper price says silver is worth $75. But the physical market is so tight, so stressed, so completely broken that one of the largest mints in America can't even buy silver to sell to its own customers. If there was real silver available at that price, do you think they would shut down, turn away customers, publicly admit they can't find metal? Of course not. They'd be buying every ounce they could find. But they can't find it because it doesn't exist at these fake prices. The paper market and the physical market have completely disconnected. The paper price is a fantasy, the physical price is reality, and the gap between them isn't just wide anymore, it's broken. Friday didn't just crash the price, it shattered the physical silver market, and the cracks are spreading faster than they can contain them. So, let me tell you what I think happens next. The shorts have covered. JP Morgan and the other banks closed their positions at the bottom. The manipulation has served its purpose. The weak hands have been wiped out. Retail traders who bought on margin are gone. All the leveraged positions have been liquidated. The market has been cleaned out. But here's what they cannot control. The fundamental supply and demand. That hasn't changed. Silver is not optional. You need it for solar panels, for electric vehicles. Every phone and computer on the planet needs it. You cannot build the modern world without silver. Demand is exploding while supply is flat. Friday's crash didn't create new silver mines. It didn't reduce industrial demand. All it did was transfer silver from weak hands to strong hands at artificially low prices. And now the physical market is breaking. Mints are shutting down. Dealers are sold out. Premiums are through the roof. This is not what a healthy market looks like. This is a market under extreme stress. I believe the recovery is going to be violent. When this turns, it will turn fast. The same algorithms that drove it down will launch it back up. And the physical shortage is only going to get worse because every crash like this drives more people to buy physical metal, taking it out of the paper system for good. The banks can manipulate the paper price, but they can't print physical silver. And right now, the physical market is screaming that something is very, very wrong. But I think something even bigger is coming. Those margin hikes tell me someone is in serious trouble. You don't raise margins like that unless a major player is about to blow up. The coordinated timing tells me this is a global issue. The physical market breaking is the ultimate confirmation. When a major mint cannot source silver, when premiums are this high, that is not normal volatility. That is a system on the verge of failure. I've seen these patterns before, in 2008 and 2020. The stress always shows up in strange places right before the big event. And right now, the stress is everywhere. I believe a major market event is coming in the next few months. I don't know exactly when, but when I decide to exit, I will tell you publicly right here, just like I always do. Let me leave you with this. We have 5 banks convicted of manipulation, hundreds of thousands of fraudulent orders, traders sent to prison, and on Friday, they closed their shorts at the exact bottom. The miners didn't crash because smart money knew this was a scam. The physical market didn't crash because the paper price is fake. Golden State Mint couldn't source silver just like in the 2020 crisis. 1980, 2011, 2026. 3 times in 50 years. Same playbook, same destruction, same recovery. This is not a free market, it's a crime scene. The question is, what will you do with this information? If this video opened your eyes, I need you to do one thing. Send this to someone who lost money on Friday, someone who feels lost and confused. They deserve to see the evidence. That's how we spread the truth. Drop a comment below. After seeing this, do you still trust this market? Are you holding, buying, or getting out? I read every single comment. If this is your first time here, subscribe and hit the notification bell because our next video could be the one that saves your portfolio. I'll keep digging. I'll keep exposing the truth. They want you to panic. They want you to sell at the bottom. Don't let them win. Now, watch what happens next. Let's talk about what just happened to silver. This isn't the first time we've seen this movie, and if we don't learn from the past, we're doomed to repeat it. Think back to 1980. Silver was soaring, but then the rules of the game were changed mid-play. No warning, no explanation. Just new rules that crushed anyone who was long. The price crashed from $50 down to $10, an 80% wipeout. Thousands of investors were destroyed. Fast forward to 2011. Silver was on another epic run, from $8 to $50. Social media was buzzing, the silver squeeze movement was born, and retail traders were piling in. What happened? The CME, the exchange that sets the rules, raised margin requirements 5 times in just 9 days, an 84% increase. The result? Silver plummeted from $50 to $26, a 50% destruction. It took 13 long years for the price to recover, and now here we are again. We just witnessed another historic rally. Social media was on fire. Retail investors were euphoric. And what happened? The exact same playbook. The CME raised margins before the crash, during the crash, and even after the crash. To make it a coordinated takedown, China raised their margins at the exact same time. The Fed chairman made a surprise announcement timed perfectly for maximum damage. And guess what? The big banks closed out their short positions at the exact bottom of the crash. Silver plunged 39% in a single session, the fastest destruction of the three, 1980, 2011, and now today. Same pattern, same tools, same playbook, same result. Every time silver threatens to break free, every time regular people start making money, every time the price exposes the weakness of paper money, the same script executes. Once is an accident, twice is a coincidence, 3 times is policy. And that is exactly why the smart money, the experienced players, held onto their mining stocks. They've seen this movie before. They know how it ends. They know the price always recovers after the manipulation. The miners are telling you something. A coordinated attack designed to shake out the weak hands and let the criminals exit their losing bets at the bottom. But the physical market knows the truth. On Friday, when the paper market screamed silver was $75, dealers around the world were selling physical silver for $120, even $150, a 40 to 100% premium over the paper price. If silver was really worth $75, why were people lining up to pay double? Why were coin shops sold out? Why was there a line at every dealer in America? But here's where it gets even crazier. I want to show you something that happened this weekend that tells you everything you need to know. Golden State Mint, one of the largest private mints in America, shut down all silver sales for the entire weekend. Their official statement, and I quote, "Not able to secure silver." Let me repeat that. One of the biggest mints in the country couldn't get their hands on silver. They had to stop selling because there was no metal to sell. The last time this happened was during the peak of the COVID panic in March 2020, when the world felt like it was falling apart, when the financial system was on the brink. That is the only other time in recent memory a major mint had to shut down because they couldn't source metal. And it just happened again, right after Friday's so-called crash. Think about what this means. The paper price says silver is $75, but the physical market is so tight, so completely broken, that one of the largest mints in the country can't even buy silver to sell to its customers. Do you seriously think Golden State Mint would shut down if real silver was available at that price? Would they turn away customers? Would they publicly admit they can't source metal? Of course not. They'd be buying every ounce they could find. But they can't find it, because it doesn't exist at these fake prices. The paper market and the physical market have completely disconnected. Friday didn't just crash the price, it shattered the physical silver market. So what happens next? The shorts have covered. The big banks have closed their positions at the bottom. The manipulation has served its purpose. The weak hands have been wiped out. But here's what they can't control. The fundamental supply and demand. That hasn't changed. We need silver. Solar panels, electric vehicles, every phone and computer on the planet. You cannot build the modern world without it. Demand is exploding while supply is flat. Friday's crash didn't create new silver mines. All it did was transfer wealth from weak hands to strong hands at artificially low prices. And now the physical market is breaking. Mints are shutting down. Dealers are sold out. Premiums are through the roof. This isn't a healthy market. This is a market under extreme stress. I believe the recovery is going to be violent. When this thing turns, it's going to turn fast. The same forces that drove it down will drive it up even faster. And the physical shortage will only get worse, because every crash like this one drives more people to buy physical silver, taking it out of the paper system for good. The banks can print paper contracts, but they can't print physical silver. I think something bigger is coming. You don't raise margins this aggressively unless someone is in serious trouble, about to blow up. The coordinated timing tells me this is a global issue. When a major mint can't source silver, that's not normal volatility. That's a system breaking behind the scenes. I saw these patterns in 2008 and 2020. The stress always shows up in strange places right before the big event. And right now, the stress is everywhere. I believe a major market event is coming in the next few months. When I decide to exit, I will say so publicly, right here, like I always do. Let me leave you with this. 5 banks have been convicted of manipulation. Hundreds of thousands of fake orders. Traders sent to prison. And on Friday, the banks closed their shorts at the exact bottom. The physical market did not crash because the paper price is a lie. This isn't a free market. It's a crime scene. The question is, what are you going to do with this information? If this video opened your eyes, I need you to do one thing. Send this to someone who lost money on Friday, someone who's wondering what just happened, That's how we spread the truth. Drop a comment below. After seeing this evidence, do you still trust this market? Are you holding, buying, or getting out? I read every single comment. If you're new here, subscribe and hit the notification bell because the next video might be the one that saves your portfolio. I'll keep digging, I'll keep exposing, and I will keep you updated. They want you to panic, they want you to sell, they want you to believe the paper price is real. It's not. That's how they've always won. Don't let them shake you out. Now watch what happens next.